So imagine you're standing on the floor of this massive state-of-the-art manufacturing plant, right?
Okay.
The machines are just humming, running flawlessly. And for every single $100 of product that rolls off that assembly line, $68 is kept as, like, essentially pure operating cash.
That's incredible.
Right. You would think the owners of that factory would be buying up every single share of the company that they could possibly get their hands on.
Mm.
Well, today we are taking a deep dive into Broadcom.
Oh, yeah. The absolute darling of the AI infrastructure boom.
Exactly. If you follow the ticker AVGO, you already know this.
Mm.
As of the April 21, 2026 session, the stock last traded at about $402.17 a share.
Which is just wild.
It is. It's riding this massive 28% monthly surge. And they have those exact staggering 68% margins I just mentioned.
Yeah.
Yet, despite this absolute masterclass in profitability, the CEO and the top executives are, well, they're quietly putting on life jackets and cashing out tens of millions of dollars in personal stock.
It really creates this fascinating puzzle for anyone trying to understand the market right now.
Exactly, because you had this undeniable fundamental powerhouse, right?
Yeah.
Clashing directly with these flashing technical warning signals.
Right. And before we start peeling back all these layers, I do need to state clearly right at the top, this deep dive is a strictly impartial analysis of the data.
Yes, absolutely.
We're looking at the financials and the market signals provided in our sources. We are here to unpack the mechanics of what's happening, but this is absolutely not financial advice.
Right. Our mission today is to figure out, what the executives might know that the everyday retail AI hype investor doesn't.
Exactly.
We're going to completely unpack Broadcom's financial health, dive into the technical analysis, and weigh these really conflicting market signals. We need to determine if this stock is genuinely undervalued beneath all this momentum, or if it's a looming value trap waiting to spring on you.
It's a multi-million-dollar question, really.
It is. And if you enjoy this kind of detailed, no-nonsense analysis, make sure to like the video, subscribe to the YouTube channel, and leave your feedback in the comments. It is compulsory. Well, maybe not compulsory, but it really helps the show bring you more of these in-depth breakdowns.
It definitely does.
Okay, so let's unpack this. Broadcom is flying high on all this AI hype, but my alarm bells always ring when a chart looks this steep. What does the raw financial performance actually look like under the hood?
Well, to understand the sheer velocity of that 28% monthly price surge, you really have to look at the scale they're operating at from fiscal year 2025 straight through to the first quarter of 2026.
Okay, maybe on me.
So in fiscal year 2025, their total revenue just exploded to $63.89 billion.
Wait, almost $64 billion?
Yeah.
Because growing revenue by that much when you're a scrappy startup is one thing, but growing at that scale when your baseline is already tens of billions of dollars? I mean, that requires a staggering amount of capital flowing into your business.
Oh, absolutely. And that momentum carried right over into Q1 of 2026. In that quarter alone, they pulled in $19.31 billion.
Wow.
Which is a 29% increase over the exact same quarter the previous year.
But, top-line revenue is just money walking through the front door. A lot of companies bring in billions and still manage to lose money because their operations are just bloated.
Right, but that is not the case here.
Okay.
Their Q1 net income was $7.35 billion, which is up 34% year over year.
Okay, that's huge.
And the metric that really illustrates their pricing power is that adjusted EBITDA for Q1, it sits at a staggering $13.13 billion.
And there it is. That's where we get that 68% market.
Exactly. It's your factory analogy perfectly realized.
Which is just incredibly rare in hardware, right?
Extremely rare. But Broadcom relies heavily on these highly specialized custom silicon designs. Once the R&D is done, the margins on those components are massive. And that efficiency translates directly to their cash flow. Right now, cash and equivalents sit at $14.17 billion, and they generated $8.01 billion in free cash flow in just one quarter. That's up 33% year over year.
Okay, I hear the $8 billion in free cash flow, and I hear the 68% margin, but I'm looking at the other side of this balance sheet, and I'm seeing a pretty dark shadow.
The debt.
Yeah, they're carrying $61.98 billion in long-term debt. I mean, isn't that a massive red flag hovering over these great revenue numbers?
Well, it sounds like a crippling amount of debt until you look at how easily they can service it.
Okay.
Think about that $8 billion in quarterly free cash flow we just talked about. If you annualize that, they're generating over $32 billion a year in pure unencumbered cash.
Ah, I see.
When you have that level of liquidity, a $62 billion debt load isn't a crisis. The market certainly isn't panicked. Just look at the stock's 52-week range.
Right, from a low of $161.61 to a high of $414.61.
Exactly. A company teetering on the edge of a debt crisis does not see its share price do that. Furthermore, they just increased their quarterly dividend to 65 cents a share.
Which is what, $2.60 annually?
Yep, yielding about 0.65%.
Okay, so the financials are basically operating like a well-oiled machine. Which brings us to the great disconnect of this deep dive.
Yes.
If the AI story is so bulletproof, why is the behavior of the people running the company telling a completely different story?
It's the classic insider versus institutional dynamic right now.
Explain that for us.
So on the open market, sentiment is incredibly bullish. If you look at the options market, we are seeing heavy call volume dominance, about 75.6%.
Meaning retail traders are betting the price is just going to keep going up.
Exactly. And Met institutional holdings, the big Wall Street firms, recently increased by 0.86%. But then you look at the insiders.
This is the part that blows my mind.
Right. We saw heavy insider selling in early 2026. CEO Hock Tan sold 170,000 shares, cashing out roughly $58.8 million. The CFO, Kristen Spears, sold about $20 million. And most recently, on April 14th, SRM Valaga sold 8,000 shares at $370.52.
So if you're listening to this, you have to wonder, if the ship is sailing perfectly, why are the captain and the navigator quietly putting on life jackets and cashing out tens of millions of dollars?
Well, you have to weigh the psychology of insider profit-taking. Executive compensation is heavily weighted in stock, right?
Yeah.
It's just standard financial planning to diversify your personal portfolio, especially after a stock has surged that much. You don't want 90% of your net worth tied up in one asset.
I get that, but the timing is just, it's suspect.
It is. When the top brass sells heavy volume right as a stock hits unprecedented highs, it often indicates they believe the stock is fully valued, at least in the short term.
Which pivots us perfectly into the technical charts. We need to see if the stock price is actually running out of steam.
Right, and the technical setup right now is a real tug-of-war. We can start with the moving averages. The 50-day simple moving average is currently at $335.21, which is a strong buy signal. And the 200-day is sitting right behind it at $333.87.
So with the stock trading at $402, it is way above both of those. That confirms a seriously long-term bullish trend direction.
It does. But we also have to look at support and resistance. That 52-week high of $414.61 is acting as a major resistance ceiling.
And if it breaks through that,
mathematical extension targets suggest it could run up toward $430. But if it gets rejected, key support levels are at $385.57 and then the 5-day SMA of $376.02.
Okay, but we really need to talk about the oscillators and momentum because I am looking at these numbers and they are terrifying.
Yeah, they are extremely overbought.
Right. The RSI, the 14-day Relative Strength Index, is screaming between 79.1 and 94.2.
Which is staggering.
I mean, an RSI of 94 sounds like driving a car at 120 miles per hour with the engine literally overheating. Sure, you're going fast, but you're begging for a breakdown. Is this short-term strength actually a warning sign of short-term weakness?
That is the perfect way to conceptualize it. Hitting an RSI of 94 means the buying frenzy has reached an unsustainable fever pitch. Buyers here are chasing a runaway train.
Right. And what about the MACD?
The MACD is at 19.59. It's technically bullish, but it's showing expanding volatility.
Like stretching a rubber band until it snaps.
Exactly. The technicals show it's overheating, which brings us to the ultimate debate of this deep dive.
Is AVGO actually worth its current price tag, or are retail traders being lured into a trap?
Well, let's look at the valuation metrics.
Yeah.
The trailing PE is currently 78.45.
Almost 79 times earnings.
Yep. And the industry average is only 47.2x.
Okay, that's a massive premium.
It is. But the metric that really matters is the DCF, the discounted cash flow fair value estimate.
Right, which strips out the hype and just looks at future cash.
Exactly. And that DCF estimate is $344.42.
Wait, so with the stock around 402 cents?
That suggests the stock is currently about 16.8% overpriced.
I mean, so the DCF model says it's 17% overpriced, and it's trading at almost double the industry PE. Isn't this the classic definition of a value trap for the everyday listener who just buys in because of FOMO?
That is the exact downside risk analysts are worried about. When a stock trades at a valuation this high, it leaves absolutely zero room for error.
Perfection is basically priced in.
Exactly. Plus, there's gross margin pressure from those custom AI accelerators we talked about, and the ever-present threat of a cyclical semiconductor downturn.
Which is exactly why retail traders often get trapped buying at peak hype.
Right. But despite all that, out of 27 analysts, the consensus rating is actually a moderate buy.
Wait, really? A buy?
Yeah. The average price target is $437.15. Truist even has a high target of $545.
But there's a low target too, right?
Yes, a low of $300, which shows you how divided people are.
Okay, so let's synthesize all this data,
Yeah.
the financials, insiders, charts, and valuation into a clear bull versus bear case.
Let's start with the bull case, the recovery and continuation scenario. It is built entirely on massive AI growth.
Right. They had 106% year-over-year growth in AI revenue. That was $8.4 billion in Q1 alone.
That is just an unbelievable number.
Plus, they have an extended partnership with Meta through 2029 and a massive new $10 billion share buyback program, providing a floor for the stock.
Okay, so that's the bull case. What about the bear case, the continuation lower?
The bear case points out that while AI is booming, the software segment is basically stagnant.
Yeah.
It only brought in $6.8 billion, which is just a 1% year-over-year growth.
Wow. It feels like Broadcom is a two-headed beast right now.
How so?
Well, the AI side is sprinting ahead at 106% growth, right? While the other head, the software side, is just taking this leisurely stroll. Can the AI side really pull the whole company forward indefinitely?
That's the big caution. Add that stagnant software growth to the significant insider profit-taking and those extreme overbought technical readings, and the bear case looks pretty strong.
So what's the actual outlook here? Short-term versus long-term? Short-term expectation is definitely consolidation. We expect a minor pullback toward that $376 support level to cool off that crazy RSI before it tries to test the $414 resistance again.
At long term.
Long-term perspective hinges entirely on sustained AI infrastructure demand. If that holds up, the valuation makes sense eventually.
Okay, let's briefly recap this tension for everyone listening.
Sure.
Broadcom is an absolute AI powerhouse with brilliant financials. But it is flashing serious technical warning signs and carries an undeniable valuation premium.
Absolutely. And as a reminder to you listening, this was a natural debate of the data, not financial advice.
Exactly. So with the stock sitting at this crossroads of extreme growth and extreme valuation, it all comes down to the big money.
It usually does.
If you were to open up the detailed option chain for the May 2026 expiration right now, where do you think the institutional whales are actually placing their bets?